Of all the companies out there, Tesla might be one of the hardest to value. So here's a quick update on Tesla's valuation. Now, my name is Brian Stoffel. As of the time of this recording, I do own shares of Tesla. And you might be wondering, why give a Tesla update in the first place? Well, the reason is that for my portfolio that I keep on Savvy Trader, every month come out with 5 cheapest and most expensive stocks in my portfolio. Tesla is almost always one of the most expensive. However, on April 6th, I came out with this installment. Sorry, it's a quarterly installment. And what I said was Tesla was actually one of the cheapest stocks in the portfolio. And you'll notice that from the time that I made that to now, the stock is up 18-ish, 20-ish percent. And even just in the past week, it's up almost 40%, which is kind of incredible. And it begs the question, well, where does Tesla's valuation stand now? Now, at that point in time, based on the information that was available then, I said, well, if revenue can grow at about 16% per year for 10 years, then it seems like a pretty good deal. And that's what revenue was expected to grow at the time over the next 3 years. And given all the products that many bulls at least hope will come to market, that seemed fairly reasonable. So where does it stand today? Well, the first thing that we have to do to figure out where Tesla's valuation stands today is look at its free cash flow. And as you can see, that free cash flow has dipped significantly, reached a high in December of 2022 of about $7.5 billion. And now it's down to just $1.4 billion. Big reason, there's been an inventory that's been building up. They've had trouble selling cars. They're spending a lot on AI. There's a lot of reasons for that. And if we plug that new $1.4 billion figure into our reverse discounted cash flow calculator, we just have to change this growth rate right here until those two numbers right above it match, the blue and the green right here. And after playing around with it, I saw that Tesla needs to grow its free cash flow by 53% per year, not for 1 or 2 or 3 years, but for 10 years to justify today's prices and for it to be just a market matching investment. Obviously, that is an insane amount, and no one in their right mind with knowing just that would ever say that this is a reasonable valuation. But the story doesn't end there. I would say that it would be a highly unattractive stock. However, it's worth pointing out that Tesla's free cash flow margins have been as high as almost 16% in the past, and that's with not all, but most just from auto sales. Now, you'll see way over here that it dipped to negative 12% in the current quarter, which is why we find ourselves in the situation we do now. But if it's going to grow back to anywhere near or maybe even above that free cash flow margin as a fully mature company with all the products it has to offer, like full self-driving, newer versions of cars, anything related to AI, an Optimus robot, who knows, those free cash flow margins are very likely going to be above what it accomplished at a high watermark when it was just autos. So what happens if we assume that it has those free cash flow margins today? Well, then that would bump up its free cash flow. If we assume a 16% free cash flow margin, that would bump free cash flow up to this figure, $15 billion. Huge difference from where it stands today. Why do we do that? Because when we do that, when we figure out this growth rate, because we're assuming that the free cash flow margins are optimized, this growth rate actually just tells us how much does revenue need to grow between today and 10 years from now to justify today's stock price if the company has a 16% free cash flow margin. 18%, that sounds much more reasonable top line growth. It's not an easy hurdle to get over, but it's much easier than 53% free cash flow growth per year. And if we happen to look at what analysts are expecting moving forward, today this is where revenue is, and the median of estimates for 3 years from now, or just under 3 years from now, says it'll be just under $150 billion per year. That's a 15% growth rate. So 18 is what they need, 15 is where it is. That's a lot closer. And it's also worth mentioning that if we assume that 16% free cash flow margin, then we need 18% growth. Maybe you're a little bit more bearish and you say it'll be about a 15% free cash flow margin. Well, then revenue needs to grow to 19% clip, and so on and so forth. And you can figure it out anywhere in between here. If the company can manage a 20% free cash flow margin 10 years from now, it only needs to grow its top line by about 14% per year. The bottom line is this isn't an exact science. No matter what, things will not play out exactly as I'm showing right here. The idea is to be able to wrap your arms around some idea of evaluation moving forward. So what I would say is the magic number for an investor in Tesla today, at today's prices, April 29th, 2024, is 34. That's if you add the free cash flow margin plus the revenue growth. So free cash flow margin in 2034 plus the revenue growth, compounded annual growth rate between now and 2034. Believe it or not, if you add those together, it needs to be 34. That is kind of your cheat sheet for Tesla valuation going forward. So if I had to say, where is Tesla's valuation today? I would say it's just about fairly valued, if not a little bit more expensive. It would not be in my list of the top 5 anymore, but I've owned it throughout, which is great news. Now, this whole series is for those who want to follow my portfolio on Savvy Trader. Savvy Trader allows you to watch someone's portfolio, but just as importantly, have access to reasonings for those buy and sell decisions and a community where you can ask me any questions. We have a very active community. You would have also seen that on April 1st, I purchased shares because I believed that the stock price was reasonable at about $172 per share. It's at about 194, 195 now. I'm a long-term investor, so that win is nice, but it's not a big deal until it's sustained itself over years and years. Now, if you're interested in following the portfolio on Savvy Trader, you can simply click the link in the show notes below and use the code YouTube for 33% off. Of course, we'll be following Tesla, and you'll see whether or not it pops up as maybe the 5 cheapest or the 5 most expensive once the earnings season for the second quarter comes to an end. Until then, Brian